Financial inclusion is increasingly gaining recognition among academics and policymakers as a crucial element of broad-based growth and development. Think of an economy as an engine that produces goods and services. The moving parts of the engine need to be greased to maximize the engine's performance. In the same way, financing is needed to improve an economy's performance. Companies and households need bank accounts to conduct basic financial transactions and to build precautionary savings. They also need access to credit on reasonable terms to operate and to expand.
In recent years, sub-Saharan African countries have made progress developing financial systems and improving access to financial services. However, an IMF study shows that more needs to be done in the Central Africa Economic and Monetary Community region. The two main findings that emerge from the study are that financial sector inclusion is lagging for small and medium enterprises, and that the economies of CEMAC countries would benefit from policies aimed at improving access to financing. SMEs are typically engines of growth and employment creation, but they need financing to expand. A cross-country survey of enterprises indicates that fewer SMEs in the CEMAC region would have access to bank credit than in other emerging and developing countries. In addition, collateral requirements for firms to obtain loans in the CEMAC are nearly 18% higher than in the rest of sub-Saharan Africa. Similarly, bank intermediation costs are high in the CEMAC region due to the lack of credit registries. The result? Higher lending rates.
Banks in the region actually do have ample liquidity, but because of weaknesses in the legal and institutional frameworks, they are concerned to lend money out to the domestic private sector. The establishment of effective collateral and credit registries would increase banks' confidence. It would allow for lower collateral requirements and lower lending rates and expand private sector borrowing opportunities. To boost financial inclusions and also reach small and medium enterprises in the informal sector, banks would need to do three things. First, lower fees associated with opening a bank account. Second, reduce documentation requirements. And third, promote bank competition. CEMAC governments can promote financial inclusion and ultimately boost growth and reduce inequality by strengthening the protection of creditors' rights and regulating the conduct of banks.
The additional economic growth resulting from greater financial inclusion would expand the tax base and support higher government spending that would also benefit the poor.